What are the scheme-related documents? The $7 billion limit. Can you suddenly just start buying foreign stock? In many places, is that Riskometer, where they show you like how risky your investments are. I have actually found them, unfortunately, again, not to be super useful. Hi everyone. About a decade ago, when we started Capital Mind, I remember spending a day reading two documents, an MOA and an AOA. The MOA was a Memorandum of Association, the AOA was an Articles of Association, and I remember going through them carefully and then not looking at them again for the next decade. But then these became critically important just a couple of months ago when we had to do fundraising for the company and when some of our employees ended up doing secondary share sales to other people. It's in that spirit that I thought we'd take a look at some of these mutual fund documents. You must have heard the line that mutual funds are subject to market risk, so please read the offer and scheme related documents carefully. So I thought today we'd bring in Deepak and Vashish to tell us what on earth are these scheme related documents and how carefully or seriously should we really take them? So on that, Vashish, what are the scheme related documents?
Three documents: the SID, the Scheme Information Document, the KIM, the Key Information Memorandum, and the SAI, the Statement of Additional Information. Broadly, SID is your operating framework for any scheme. So when any scheme is launched, first the AMC goes and shares a draft with SEBI. If SEBI has any objections, then they will flag it to the AMC. Once that process is over, the AMC has to upload it on SEBI's website, where it stays there for, I think, 8 working days for public comments. They can do it. Usually, I don't think anyone goes and comments on these things. Once that period is over, then the AMC is allowed to launch the scheme and do their NFO. This will tell you where the scheme can invest in, what will be the asset allocation, what is the overall fees maximum that they can charge, who the fund managers are, all the information you need, how the valuation will work, what instruments they're allowed to invest in, and so on. Everything will be there in SID. This SID is actually shared with the fund accountant and the custodians. They will refer to it when they are valuing your holdings, when they are doing their fund accounting, when they're and even your compliance. If you're setting up rules in your order management systems, you have to do it as per the SID. So, for example, if it's equity scheme and your maximum is or your minimum is say 65% equity, so that comes from the SID. You can't breach it, which is why you have to put it in your order management system. Those rules. The KIM, the Key Information Memorandum, is like the highlights of the SID. So, if you only want the essential information you care about and not the boilerplate, then you go to the KIM. It will give you all the highlights, who the fund managers are, what the scheme is doing, and so on. The SAI is it's the overall document for the AMC
Fund house.
for the mutual fund. It will tell you who the sponsor is, who the AMC is, who the trustees are, who are the board of directors, who are the key management personnel, their education and professional backgrounds, the financial status of these companies. So everything you need to learn about the three entities that make up a mutual fund, is the sponsor, the AMC, and the trustee, and all the KMPs involved. You will get it in the SAI.
Okay, got it. Monthly fact sheets, are they a scheme related document? It's actually the only one I seem to keep getting constantly.
It's a marketing document. It's not mandated. It's best practice followed by all AMCs, where we send out a monthly fact sheet. Also because a lot of these information aggregators needed this. So the fact sheet becomes the place where you get all these things, where you disclose a bunch of things. It's anyway, all the information you have in a fact sheet, your holdings, your fees, and AUM, and so on, you are anyway going to disclose it on a monthly basis as part of regulations on your website. This is like you collect all of it, put it in a nice looking document, make it easy for investors to see it.
So like a quick reference.
Yeah.
All right, fair. So Deepak, we have the landscape of what these documents are. I have a confession to make. I don't think I'll spend much of my life reading scheme information documents or scheme related documents. So on that, have you spent a lot of time reading these? And do they matter? I mean, other than perhaps being this boilerplate thing we ask for.
I used to read IPO documents for stocks, right? So it is complicated, and after a while you get a feel for where to look and what to look for. But the thing is that you have to read these documents end to end, just to understand whether you get a feel for the numbers and a feel for the risk factors and so on. SIDs are somewhat similar in the sense that if you're nerdy about it like I was, you probably want to look through them to see if there's something interesting out there. But by and large, they've become boilerplate in the sense that almost everybody does everything similarly. But it is the structural document. So, for instance, if you have a flexi cap fund, you want to say, I have the flexibility to invest, I can invest in X and Y and Z, but I can't invest in foreign securities unless the SID says that I can invest in foreign securities. And if there is such a clause, there needs to be at least two fund managers, one for the Indian stocks and one specifically for the non-Indian stocks in that sense. So if that is done, that is something that is part of the SID. The SID also mentions a few things. For instance, who the fund manager is, what the fund manager has done in the past in terms of managing other funds and so on. But it'll also tell you this is the different options that are available for you as an investor to invest. For instance, I might have a dividend growth. I might now it's no longer called dividend, IDCW and growth. We might say regular and direct. There is an option of doing an SIP, but we have only a monthly SIP. Another scheme can have a weekly SIP and so on. What's the minimum SIP that you can do? Some places 100 rupees, some places 1000 rupees. What's the minimum lump sum that you can do? It's 5000 rupees or 1000 rupees. So you have all these details sitting in the SID that gives you the information, and also some esoteric information about what happens when you invest in certain categories. So if I invest in derivatives, what does it mean, and how much can I invest in derivatives, and what's the specific way that I will value looking at securities derivatives, how the scheme will go through examples of what it means when I do covered calls, if I'm doing covered calls, and so on. So there's a lot of documentation that's in a large document format, maybe 100 pages, a lot of which is repeated across multiple funds of the same category, but usually too dry to read unless you are very new to the subject and you don't understand anything. You will find that this is generally something that you've read once, then you probably read forever.
I think a question for either one of you. How binding is this SID? Like, for instance, I learned much to my dismay that because of a certain clause in AOA, we couldn't sell these cups because that wasn't our line of business, even though people wanted to buy them. So we just ended up giving them away. But apparently it could have been changed. I'd like to ask you, uh, if we want to change, let's say someone decides that foreign stocks is the way to go and RBI is willing to relax that limit, right? The $7 billion limit. Can you suddenly just start buying
No.
foreign stocks? What do you have to do to get a...
It's a question of what is a fundamental attribute change or a material change. Something that's not material change. If you're fixing a typo in this idea, then it's not a material change. But if something like this, where you have not said, I'm going to invest in the asset class, but now you're saying, I'm going to do it, it will be a material change. For that, you'll have to update the SID. When you make a fundamental attribute change in the SID, you have to give an option to unit holders to exit without being charged an exit load. So we can't operate outside of the rules defined in the SID. It sets outer bounds of this is the overall framework and within which you need to operate, but it doesn't prescribe exactly how your day-to-day needs to be run.
Okay. I think from the sound of it, it's almost like a constitution or something. I mean, or if you ever want to understand what's happening, this is the one document from which you should be able to get all the information you need about your mutual fund to be able to either hold them accountable or not. And now with enough of the fancy AI tools out there, I guess you can actually upload it and ask questions from it without having to read the whole
Well,
thing.
you'll probably need more. For instance, there's something called a valuation policy. The valuation policy is also uploaded on the AMC's website. It tells you how the AMC will value certain instruments that it buys. There's something called a stewardship code, which says that if you buy a stock and that stock has a company has an AGM and they want a bunch of proposals that need to be approved or disapproved or rejected, you are going to have the fund manager go through each of these things and then choose whether or not to approve them. And they have to disclose this on their website. There's a stewardship code that every mutual fund needs to have as an AMC. And you can go to the website of the mutual fund and say, oh, what is your stewardship code? What is your valuation policy? What are all the other policies that are available to me as an investor that work in conjunction with the SID, on top of which there are the SEBI regulated rules. So for instance, I cannot have a large cap fund whose SID says I will invest in the top 200 stocks, because SEBI's regulation says, well, a large cap fund can only invest in the top 100 stocks as defined by AMFI, with 80% of their AUM, which means that the SID has to kind of corroborate that down, to that level, but it will not specify the 100 stocks. It will say we will do it as long as along with the AMFI definitions of the top 100 stocks, which changes every 6 months. At the same time, you have all these documents that have to be read. If you put them into an AI framework, AI framework will probably tell you a bunch of things. Then you suddenly might find that, listen, I saw the portfolio and I'm asking it, and it doesn't seem like this is somehow valid. But the language itself usually is vague enough to allow the fund manager the flexibility to say, well, you know what, markets have changed. I mean, if I choose a stock that says, well, we are high dividend yield, and it's a high dividend yield mutual fund, then is high a 1% dividend yield, is high a 4% dividend yield? The answer is nobody knows. And if it's just written high, then you could choose a stock with 1% dividend yield sometimes and 4% dividend yields a different time. So you necessarily have to have the language almost always that allows a certain level of flexibility to the fund manager, which is why usually you might be like, oh, is this a dividend yield fund? How come it doesn't have this stock which has such a great dividend yield in it? Anyways, these are questions that you could ask the fund manager perhaps, but they will not be violating the SID per se.
All right. One thing that I know forms part of these, I think, scheme-related documents in many places is that Riskometer, where they show you like how risky your investments are. I have actually found them, unfortunately, again, not to be super useful. I mean, I know they have a purpose and then they have a methodology. But in my life, I'm like, when things have to go wrong, your ultra short-term fund will not be able to return your money to you. Your index fund will have some stock that is suddenly no longer trading and you won't be able to get money out of it. So I've become very skeptical of the Riskometer. So trying to be provocative here, but should I just ignore them? Or is there a place where the two of you have actually found it to be helpful rather than just be this legalese or just something you have to do? Maybe Vashisht first.
It brings some standardization, so that if otherwise in this absence, if you were to tell AMCs to describe some kind of a risk measure for each scheme that they have, what would they do? So everyone can come up with their own measure of things. Now we have more. It's not just a Riskometer. We have to disclose, I think, information ratio and Sortino ratio and Sharpe ratio and whatnot. But they're all, make sense in certain contexts. Riskometer is a more like a visual indicator of you see it immediately, you know whether it's a risky vehicle or not. In that sense, it makes more sense when you're comparing schemes within the same category. So if you look at equity, almost all of them will be high risk or very high risk, whatever is the highest. But say you're looking at hybrid schemes, some of them may be moderate, some of them may be high risk. So you will notice that, why is this difference? And then you'll see, some of them are more conservative in the things that they pick. Some of them may not be as conservative. They will be more aggressive within the same category itself. So that's where one use case for the Riskometer. Also, Riskometer tells you the Riskometer of the benchmark they are using. So when you're comparing the two, the scheme's risk category should be the same as benchmark. If it's higher than the benchmark, then you have to ask why. If it's lower than the benchmark also, you should be curious why is that.
Deepak, do you like the Riskometer?
It's an interesting tool for debt funds, because I think that in a debt fund, the idea of risk, for instance, if you saw a liquid fund, you would think of it as saying, it should have the lowest risk possible.
Sure.
But there are some funds which don't have the lowest risk. So in certain cases where they take on a certain layer of credit risk by buying into bonds that mature within 91 days but are issued by a company that does not have the highest credit rating possible, you end up with a fund which goes into a different risk class, and therefore the Riskometer may show a difference. This immediately strikes you because you're looking, wait, I thought I invested in this fund for the lowest risk, and look, they have a higher risk. the same thing applies in a lot of hybrid funds as well, where you might say, oh, some funds have a higher risk versus low risk. Because in debt, the riskometer is an algorithmic parameter. It's not determined by the fund manager. It's not like, oh, I want this level of risk, that's why I'm going to do this. Whereas in equity, you almost always take the highest risk class available because you know that equities are going to be risky and volatile. But here's the interesting thing. I feel over here one of the problems of the riskometer definitions is that because it's algorithmic, sometimes you will switch between one risk area and another risk area just because, when I say it's algorithmic, it's like this: you got a bunch of investments. Some of them are government securities, some of them are corporate bonds, some of them are lesser rated corporate bonds, and so on. So now, when you have a combination of this, today it may correspond to one particular area, saying, it's moderate risk. But tomorrow, because of credit rating of one of your bonds has fallen, you could automatically switch into the higher risk class without the fund manager having done anything about it. So the fund manager will have to now actively take action and say, I want to reduce this bond as a proportion of my portfolio so that I remain in the same risk element of my risk matrix, to be able to kind of use the riskometer appropriately. But in general, in equity, riskometer is usually volatility-o-meter actually, because it just simply doesn't tell you that. So in effect, if I were looking at a 5-year or 10-year horizon, equities have been actually very low risk, in the sense that
Famous buzzwords, but okay,
yes,
yeah.
in the sense that we've never had a really long 10-year period where returns have been negative. We've very rarely, if ever, we have. So the risk is basically the chance of your permanently losing capital. If on a 10 years your chances of permanently losing capital are taken in equities, even equity funds, I think there will be a very small percentage of funds that have it. But can you say that on a 1-year basis, my volatility, which is up and down, that I would face, is going to be high? The answer is yes. So that's why you choose the highest risk possible in an equity fund, simply because the volatility is very high. Whereas in debt, there is chance of permanent losing capital simply because bonds are illiquid and they have the chance of defaulting, where you will lose permanently a lot of capital, and there's no easy way to make it back. In equities, if I have 5 stocks, 2 of them can go up 300%, well, 3 of them can go to zero. So even though I've lost capital in 3 stocks, I've made up capital in 2 or 3 others. In debt, when it goes up, you get 8% or 10% or 12%. But when you lose 100%. So there is a disproportionate loss. So in that sense, the riskometer actually makes a lot more sense for a debt fund than it does for an equity fund, where equity fund, it behaves more closely to a volatility meter than a riskometer itself.
I do remember, in a happy way, learning that debt funds aren't risk-free, because I bought a bunch of what I thought were short-term government securities. They turned out not to be so short-term government securities in a mutual fund. And so when interest rates fell, my debt fund was doing better than my equity fund at one point of time because of some weird duration thing. So life can be interesting, as I've learned. And presumably it could have gone the other way, but luckily it did not. Sure. So look, so far what we've covered is factual, but I have 2 questions here that are more of opinions while still relating to mutual funds and then these scheme-related documents and fundamental characteristics. The first one, please, whoever is more opinionated can take. Why on earth do we have these dividend plans in the first place? They don't even seem to be called dividend plans. I don't even know what they're called anymore. But why do they exist? Dividends are so tax inefficient for pretty much everyone, right? Shouldn't we just do away with these? And sometimes they cause confusion because a person thinks that they have a growth plan, but they don't. And that is fairly unfortunate. Where would you go with this?
Well, dividends didn't used to be taxed like it is today. So I think this is a relic from that point. And but it has a lot of history. I think Deepak will know all the history of dividend plans, dividend reinvestment plans. And there were plans where they would be selling hybrid schemes to retirees, saying "Ki this is a fixed income you'll get every month." But it was effectively a mix of dividend and some of their capital being given back to them. So I think all of those have been fixed so far.
Okay. So
Yeah, no. The history is intense because I think it was 2005 when dividends went off the taxation bandwagon, and or 2006, I don't remember when that was. But since then, mutual funds then decided to call their payouts as dividends, but it's not necessarily dividend. For instance, if a equity fund invests in 100 stocks and all those 100 stocks pay you 1% dividend, that means technically you have 1% available to distribute as dividend, and then you should be able to distribute them. But guess what? The 100 stocks also went up in price by another 10%. So now you have 1% dividend, but also 10% increment. So I have 11% that's available to distribute. So I maybe do a 2% dividend. So this is not just dividend. So they call it an investment distribution and capital withdrawal. So 1% is the capital that has grown and that you're withdrawing from. So it's called IDCW, which I don't even know what that means. But the problem with that is that after 2019, I think, is when they started getting taxed. So since they were not really dividends, and then dividends of companies also started getting taxed, dividends paid out by mutual funds are also taxed. And this is a problem because now it's mostly your capital growing. And if you take the money out, if the mutual fund pays you out something, you're going to get taxed on that dividend in full as income. Now, like, I didn't do anything. I just invested in something for the long term. They paid out some money to me, which I didn't want in the first place. And I'm paying dividend on that. I mean, tax on that. That sounds unnecessary. So the growth option just takes the money that's with the the mutual fund receives as dividends and reinvests it automatically. So that's a growth plan. Now, some of these when dividends were not taxed, it was actually tax efficient to do a dividend reinvestment. Get the dividend, have that dividend buy new units. So essentially, you are booking out profits from the fund without any taxes and then reinvesting it back. But if there was
You are increasing your cost of acquisition.
your cost of
So your
acquisition,
ultimate capital gain may be lowered because you're averaging your cost.
yes,
Okay,
but at
okay.
that time, capital gain was not taxed.
Yeah.
So it was very strange of why you would choose to have a dividend reinvestment plan in the first place. Because there was a time in which capital gains was taxed and dividends were not taxed. So therefore, you had an idea, dividend reinvestment. And even today, there are relics of that time. For instance, most ETFs, you don't have a growth plan. An ETF can choose to distribute dividend anytime it wants. And because EPFO used to own one of the largest, they own even now more than 90% of one of the largest Nifty 50 ETFs in the country, they essentially forced the Nifty 50 ETF to pay out dividends. So other people owning this Nifty 50 ETF for no fault of their own suddenly started getting dividends on which they were taxed, right? So this is, as I'm talking about, 1 or 2 years ago. And then it took some time
I
for
think it was in the middle of the pandemic, so everyone's a bit taken
aback by
surprised by
this,
this.
yes.
But anyway,
And eventually the EPFO people had to be trained to say you could sell these units
instead of us,
yes, you could redeem them back with the mutual fund house, and they would pay you back those units in terms of stocks, and then you could redeem them. And that was a much better way to book your profits than to try to actually force the fund to give a dividend to everyone else. So that was one layer of this. The other one is there's a liquid ETF. The liquid ETF is typically what is used by people who are trading in the market to say, I have some excess cash remaining in my brokerage account. Instead of it not yielding any money, let me buy something that's a liquid ETF. And most of the original liquid ETFs that came about in the country had a daily dividend reinvestment process. I mean, daily they would pay dividend so that the NAV would remain at 1,000. So 1,000 rupee NAV was what you paid was 1,000 rupees. And then if it earned some money overnight for it, it would earn maybe 5 paisa. That 5 paisa was then taken out and then reinvested in new units because you could do fractionals as well. And you would automatically get new units, but the NAV would stay at 1,000. Even today, such ETFs are available. Unfortunately, because it's so tax inefficient, your NAV may be 1,000. At the end of the year, somebody is going to send you a statement saying, listen, you had so much dividend because you had maybe 10 lakhs or 10, 15 lakhs sitting in this ETF. It's paid out maybe 50,000 rupees. And on that 50,000 rupees, you have to pay full taxes, of which we have deducted 5,000 rupees as taxes at source, TDS at source. So it doesn't help you at all because this TDS, first of all, whatever dividend you receive, the TDS is 10% of that. So only 90% of the money is available to reinvest. And then on top of that, you have to pay tax on that overall money that you receive as dividend as well, because your tax rate may be higher than 10%. So this dividend reinvestment is a relic of the past, still remains in certain ETFs. Some funds you cannot choose the growth option because they are ETFs with only a regular option. Only a dividend-ish kind of option. And
Or there is no option.
there is no
Just
option.
buy it
Yeah,
and they
just-
do what they want.
They do what they want. So yeah. So I mean, I think that's where this thing is. I'm not a fan. I think right now growth should be the only possibility
Well, we don't have a dividend option in our scheme.
in us. Yeah.
But
We only have
so
growth.
I actually, again, I know I'm coming with my bias, but look, if first I'll just remind a book that both of you recommended to me, which I did finally read, was the one by Ed Sharp. I can't remember the name, but where he was where he talked about how the universe, everyone seems to prefer getting a monthly income rather than having a capital base which they have to withdraw from, and that was fairly interesting. And I see that here. But the fact is that if you invest in a mutual fund, the mutual fund buys a stock. That stock spits out an enormous dividend. The mutual fund is able to accrue that dividend tax-free, reinvest it for you, and grow tax-free. Had you owned that stock directly, you would be disadvantaged because the moment that thing showed up, you'd have be at, I don't know, 36% tax on it or not. So it really feels like you're giving up the benefit of a mutual fund today by having it pay you back some dividend. But I concede, as you've both pointed out, that taxes are always changing, and so products cannot
Even if
exist.
it's changing, I think the growth option is still the most
Probably the better.
simplest one to stick with, because whenever you need cash, you can just sell and get it. And now you have all these options, right? SWPs, you can do systematic withdrawal plans. You can just put it in a growth plan and then do an SWP. Every month you can get the money back. And it'll be capital gains. It won't be income.
Yeah, I mean, in fact, mutual fund is, since it's the most tax efficient vehicle for even getting dividends. Sometimes there are these opportunities in the stock market where a stock is giving a ridiculously high amount of dividend. Now, unfortunately for me, let us say I own that stock for 10 years. And the stock price is 1,000 rupees, and suddenly this company wants to pay 800 rupees because it has sold most of its business to somebody else. It wants to pay 800 rupees as dividend. I hate it, because at 1,000 rupees, if I sold it, I would pay 12.5% long-term capital gains tax. But if it pays me 800 rupees as dividend, I am automatically taxed to that 800 rupees at the highest possible rate. So at which time I am saying, listen, I would rather sell this. Now, if there were only people like me, nobody would want to buy this stock, because they would be like, listen, I'm not buying it at 1,000 rupees to receive 800 back of my own capital.
Taxed at
Taxed at 36% or 40% or 35%, 36%. So this is where a mutual fund can step in and say, listen, you want to sell, I'll buy. I don't have any taxes on the incoming dividends. So I would therefore be the buyer for that stock. In fact, because of, in one such situation that actually occurred, the stock was selling for less than the dividend was going to pay out. Because the individuals receiving this were like, we don't want it, because I'm not going to pay 800 rupees to pay. Yeah. So they were dumping it. And at that particular time, it wasn't apparent to me why, but no mutual fund was jumping in trying to buy this stock. And it was really surprising to me, because I was like, it's almost like free money. I mean, if I paid 800 rupees per stock to get 850 rupees worth of dividend, this sounds like it's a free 4% or 5% gain for a mutual fund. But sometimes these are not, maybe they're, at that particular time it wasn't obvious to the mutual fund universe. But now I'm sure it is, and lots of interesting things happen from that perspective. So I think this concept of dividend has evolved in a very, very strange manner.
Mirroring tax regime changes as well. So I think I concede that this podcast itself, this segment of the podcast may become wholly outdated in 3 years when taxes change once again or whatever. But point is taken. Sure. The last one I know you're both very passionate about, so my apologies for saving it for the end. But one thing that has always bothered me is that India's biggest fund managers are mysterious index manufacturers who we use as benchmarks, but also then create products based on these indices. So Vashish was mentioning that when you have a scheme, if it's riskier than the benchmark, then you should justify that. And if it's less risky, you should justify that as well. And normally when I think benchmark, I think, Nifty 50. These are surely simple, deterministic, rules-based things you follow. But I think over the years, there have been a lot more benchmarks or indices created. Not all of them seem to follow simple rules. Sometimes they claim they follow rules, but then they actually don't. And then if you ask, they're not obliged to reply, or they're like, who the hell are you? And so I feel there's a lot going on where people are using index manufacturing as a way to create, like, I mean, in a sense, what look like passive funds, but actually aren't really passive in any meaningful sense. And there is discretion involved here as well. So I know you both have a lot to say, but I'm just throwing this out there. Uh, how much of a benchmark are your benchmark indices really?
Only if they are broad-based, market cap weighted indices, which don't change as often. So Nifty 500 or Sensex 500 or Nifty 50 and so on. I think those which incur very little transactions, the turnover is very low, maybe rebalanced once in 6 months. Those are the only truly passive vehicles. Everything else, now we have hundreds of these indices from both manufacturers, and there are only two. And I think it's also they also provide it as a service, where if you want to create a product, you can approach them, they'll create a product for you, and then you can launch an index fund or an ETF on that index. But each index, apart from the broad ones, are basically backtests now. Like you can take one factor, take one universe, or combine two factors, and then you have any number of combinations, and you'll have basically each backtest becomes an index.
Like a value plus growth index.
Sure. And then you can do it on the top 500 or the top 150 or the middle 150, and each one can be different. It can be top 200, and then from the top 200 universe, the best 30, or the top 500 universe, the best 50. You can keep creating these combinations endlessly.
And there's no limit on the number of, since it's based on an index or a...
So while we have categories, SEBI has created these categories 2018. I think there's a new consultation paper happening in the works where we are reassessing those categories. But there's no limit on the number of index funds you can create. So you can have like, okay, I can only have 20, 30, 40 categories, whatever. But index fund, I can have hundreds of them. And there's no limit on it. So I think it's getting abused a little bit, both under thematics as well as indices. I think we'll see some action there soon. But the other bigger problem I have with this is index manufacturers are not regulated. Unless you have an index with more than 5 crores earning on it, there is no regulation. 5,000 crores. So, and there was no even a regulation like anything with the name index manufacturer or index provider till I think last year. So up in 2024, there was zero regulation on index manufacturing, but they are quasi fund managers. So
and the biggest ones in the country.
So it makes they have to be more responsible. So I need more transparency from them, and there should not be a duopoly on providing indices. I think only exchanges can today create indices. I think the reason is because they claim copyright on the prices. I think stock prices should not be copyrightable, and they should be public information. Anybody should be able to use it. I think there was some discussion on it from the regulator before, whether some of this data should be provided to everyone for free. Well, they can obviously charge for it, but they can't have exclusive ownership of prices because they are not created by them. It is created by the entire public trading on public stocks.
I think my view on this, I'll give you one thing particularly on the index manufacturing front. The index manufacturers have the same economics as the fund managers, except they don't have any regulation. So which means that an index manufacturer can say that if you use my index to create an index fund, please pay me 2 bips, 3 bips, a percentage of the amount you manage. Now, mutual fund manager exactly the same thing, right? So mutual fund manager also saying, listen, I earn a percentage of the funds I manage.
Hopefully more than 2 bips, but no.
Well, yeah, I mean, this thing. But, in some of the index manufacturers charge as much as 10 bips. So they are quasi-fund managers without the regulation. So I don't think that's fair. I think that's important to bring them under the regulatory universe as well. So you want to be sure there isn't any hanky-panky when they select stocks to do this. And they often make confoundingly difficult to understand decisions on certain stocks. So you would think the Nifty 100 equals the top 100 stocks by free float market cap. That's it. That should be the end of that story. But no, they will agonize over, oh, this stock has now come into the top 100, but can we somehow not include it, or can we don't know. So people actually take wager over whether stocks are going to get included in the top 100 or the top 50 by thinking about, oh, whether is the index manufacturer going to allow this stock to be a part of that index or not. And if it does become a part of the index, the stock goes up. To give you an example, there's about 7 lakh or 8 lakh crores chasing just the Nifty 50 as an index. Okay, so the adding a new stock to the Nifty 50 index would involve a corresponding amount of money. Let's say a new stock comes in with a 1% weightage on the Nifty 50 index. Of 7 lakh crores, 7,000 crores is going to flow into that stock, and it's all going to flow in one day. And 7,000 to be in the Nifty today, you probably need about a market cap of 1,50,000 to 1,75,000 crores. If you give 7,000 crores to a stock which has about 1,75,000 or 2 lakh crores, that's 3.5% of its overall stock. This thing. So assuming that some of these stocks have like 70-75% ownership by promoters, the free float is actually relatively small. I mean, that way. Although to be fair, free float is what is considered. But let's say 75% is held by institutions. The float that is actually being traded in the market is only 20 or 25%. Now, index funds have to come and buy in another 3% of that stock. That constricts the free float even more. When I say free, I mean like stuff that's normally traded in the market. You end up with this position of a stock finding it prestigious to be in the top 50 stocks of the country, not because they're the top 50 stocks, but because 3.5 or 4% of that stock is locked into funds that can't sell as long as the stock is in the top 50. So they can't sell because you're performing badly. They can't sell because you're doing something wrong. So every company technically now wants to be
in some equivalent of this.
And the managers that are deciding this are not human managers. I mean, they are human, of course. They're not managers who are beholden to a trust of investors who can question them on why have they made the decision. They're completely independent players saying, listen, we made our index, we're doing it, we're doing whatever we want. You can't question us on why we've added or not added a stock. So this adds a layer of discretion, which I think is not useful. Another second part about this index fund piece, and I think there's a smaller thing, is that because they have the economics of fund manager, of mutual funds itself, they are not required to educate people at the same time on how complex, risky, or otherwise useful their indexes are for people of different risk weightages and categories, whereas a mutual fund is required to do so. I think adding that layer is also important to say that your dissemination should be public.
When we were creating our NFO presentation and so on, we had to give disclaimers saying this is all historical, this is all simulated information and so on and backtest. Index fund providers, when come up with a new index, they create a fact sheet, and it looks like they don't have as many disclosures there saying that, oh, look, this is all simulated, it is not real. I mean, it's not actual performance and so on. So they are playing by much looser rules in that sense compared to actual product manufacturers.
I think just two reactions to what you've both said is the first is I think when these benchmarks started out, they were more boring. Nifty 50, Nifty 500, mid-cap index and whatever. And so there wasn't as much of a need for regulation. But then either through the cleverness of market participants and the ambition of the people running these, they realized that they could do a lot more. And so let's create indices that are in a sense...
It also took a while for them to normalize.
Yeah.
There was a period, I think 3 or 4 years, where Sensex was free float market cap weighted and Nifty was
I think the other way.
full market cap weighted.
Oh, wow. So
I think there's a long period of 2-3 years where there were different methodologies and used by the two most important benchmarks.
To be fair, the Nifty, the way the top 100 stocks are determined is based on full market cap, not free float by AMFI. But the indexes are based on free float. So you could have a stock in the top 100 that does not appear in the Nifty or the BSE 100 simply because they take free float and the AMFI does not. So what do you do as a large cap fund? Can you,
When you benchmark against the Nifty
Yeah,
100.
yes.
Okay.
So it's a very interesting change in thought process. Yeah.
Okay. And the other one was, I think the point that we're really trying to underscore here is that there are people who presumably are invested in making the Indian market ecosystem stronger. They are taking decisions that they probably feel are in the best interest of investors. But it becomes you're ending up taking these decisions in a sense, quietly in the backgrounds without as much accountability. So even if you are actually saving us all from the worst possible outcomes out there, this is not something that deserves to be in back rooms and needs to be brought out in front, just like everything else eventually has been.
Yes, and I won't even go into debt, because in debt it's so complicated that when they created a bunch of indexes around with debt products from certain companies, they literally had to say, listen, they have a debt instrument that's not exactly the same debt instrument, because that company did not have the exact same instrument available. But these guys have bought some other fund which is kind of close. This kind of close is now another rule that complicates matters around debt. So like you said, at some point all of these rules, these arrangements and all that stuff need to be more publicly vettable, maybe questionable, and like Vashish said, that without having to have more than the two index providers that we have, with no copyright on prices by the exchanges.
Also, as an investor, if somebody is launching a index fund, it's fine. How do I verify whether because you are required to disclose the methodology for that fund, but without seeing the historical holdings for which you have created the historical NAV curve, how do I verify whether you consistently applied the same rule set or not? So based on whatever is disclosed by index manufacturers, I can't independently verify whether the sanctity of the historical backtest, because they don't share the historical holdings.
Fair. I think that's well understood. If you're a fund manager, then by all means, you need to outperform your respective index and you're sharp and on top of this. But if you're a person investing, then what is your opportunity cost of the simple decision you could make? Realize when you're investing, sometimes things will go well, sometimes they won't. But often it's been understanding the fees.
There is some fine print and there is a little more to understand here.
AMCs with a lot of funds could charge a higher fee for some funds and a lower fee for some other funds.
But then who is this person on the other end who actually wants this for a day?
Banks and sometimes other players in the TREPS market, they are always looking for overnight liquidity at some level.